Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Peter Hugg. He is the director of Kitco Metals, Precious Metals Division. He's a real expert on the whole world of precious metals. Welcome to the show, Peter.
Pleasure to be here, Jordan.
Just give us a little bit of your background. You've been in the metals market a long time, but just give us a little bit of your background and history.
Oh, my God. I came out of university, the University of Toronto up in Canada back in late 73. I cut my teeth originally in the business in the foreign exchange field, worked for a company back then that was the largest global retail supplier of foreign exchange, a company called Deak-Perera. Subsequently sold to Thomas Cook, but I was with them for 3 years, and then I joined a bank in Canada called Guardian Trust in late 77, and we were fortunate enough, my primary function there was to develop the foreign exchange business, but we also decided to foray into the precious metals market, so we were lucky enough to get into the markets prior to that first major bull run in gold in 1980, where gold went to approximately $850 and silver went up to $50. And we became one of Canada's, next to the Bank of Nova Scotia, largest wholesale precious metals dealers throughout the 80s and mid-90s. I then left the business and just as an aside, I was the CEO of a public company that introduced microchip technology identification for pets in North America. Did that for about 5 years. And then I basically retired. I ran a country inn in Niagara-on-the-Lake by Niagara Falls. And then in 2009, I got a call from Kitco. And they asked me to take over their precious metals division. They had some 220 employees, and one of the divisions was retail precious metals. Kitco was the first company ever to sell metals online. So I took that over with an indication I'd give them 3 to 5 years just to get them back into sort of line and put in the processes and set up their trade operation. And 10 years later, I'm still with Kitco, so that's where you find me.
Very good. Okay. So you've seen a lot of the cycles in the gold and silver market. So let's kind of start at a broad view here. So we've had an enormous rise in gold prices the last year or so, with gold hitting well over $2,000 an ounce, silver having a big move into the mid-20s. What has been the primary driver of gold and silver prices in the last year or so?
When you use the context of last year or so, I mean, the gold market was showing signs of a bullish trend late 2019, but was still sort of confined in the range and sort of trading between the 1550, 1650 parameters. Silver was having difficulty getting north of $17 and trading most of 2019 in the 15 sort of 1650 range as well. When COVID hit in early March, the first reaction for the metals was actually down as everybody noticed the stock market collapsing from, if I remember, the high was just about 28.5 in Dow, collapsing all the way down to almost 18,000. The NASDAQ collapsing. All of the financial indexes were collapsing as the U.S. government closed the U.S. economy. The original context of that happening in the financial market caused the metals to sell off from the perspective that the original reaction to the drop in the equity prices were that this was very temporary. But when the extent of the drop was becoming evident, people were liquidating gold and silver just to raise cash for either to meet margin calls in their equity positions or just because they were totally panicked and they were raising cash. So as that first sort of 2 weeks of COVID and the closing of the U.S. economy took hold, you had gold drop all the way back down just north of or just south of 1,500, and silver actually touched $14. It was then that the Federal Reserve came out and, along with the U.S. government, just massively inflated the economy with a massive stimulus program of the equivalent between the two groups of almost $3 billion. I'm sorry, $3 trillion with a T.
Right.
When that was announced by the Fed, and then they subsequently announced that they would hold this policy in place until 2021, it was the green light for the metals. And gold started to move. And the first target that gold was looking for was the 2011 high, 19 and a quarter, which it took out fairly easily in April. And silver was a laggard, and the reason silver was a laggard was because the global economy was shut down, not just the U.S. economy, and the industrial demand for silver, for things like solar panels and the electronics industry, was basically just ended. It just went to zero. So there were still above ground supplies in silver. So it took silver a while sort of to catch the wind, but it did that about 6 weeks ago and broke up through 19 and a quarter, which was been a significant resistance level for silver over the past 3 or 4 years. Once it got there, it was clear sailing and got almost as high as $30 about a week and a half ago. And gold, as you mentioned, hit almost 2,200 before it retraced back and is now trading in the low 1900s. And silver is still trying to maintain that $26 big figure price target.
So you're saying it was pretty much the Fed. Now, it was not only the Federal Reserve, it's the European Central Bank, Bank of Japan, Bank of China, all the central banks around the world had massive liquidity injections at the same time. It was not only the Fed that made this happen. Is that correct?
No, absolutely. Yeah, absolutely. It was a global event from a liquidity perspective. Added on to that was the U.S. government throwing another $2 trillion into the pot with the unemployment insurance benefits and the checks that they were cutting for families, that qualified under their income based on 2019 tax returns. But the two together was almost the equivalent of $3 trillion, just unheard of.
Now, some would say that the plunge in the economy worldwide, when economies were shutting down, is a massive deflationary event, right? Less demand, prices falling because there's not much demand for things like oil, going to minus $38 briefly. So normally you'd think that the inflation coming from the Federal Reserve and the monetary authorities would basically just balance off that huge deflationary impact. Why is the gold market seeing it as inflationary when the major trend seems to be deflationary?
Well, I don't think the gold market originally in the sort of the March, April, May area time frame there was perceiving this as an immediate inflationary impact. There seems to be this movement in the gold market where there is day by day, and that's why you're seeing this volatility. The impact of what happens if we do get a vaccine. What happens if the U.S. economy goes fully back to work? And the test on that, I think, is going to come when the schools open. I mean, that to me is sort of the watershed test. If the kids can go back to school and they're not bringing COVID home to their parents/grandparents, then I think people will have a higher comfort level to go back out to work. You have to imagine that there's a lot of people that haven't been at work, not because they're not capable of working outside of their homes. It's because they have no place to put their children. Now, if school comes back and re-engages fully and the kids can leave their homes at 8:30 in the morning and come back at 5 o'clock, so the parents then have the freedom to go back and work, that I think is going to be a major accomplishment in this fight against COVID. But I think what the gold market is looking at is it may take another 2 or 3 months, but the gold market seems optimistic that there is going to be some type of cure, for lack of a better word, for COVID. And sometime in 2021, this economy will be at full gear again. But the Fed will remain on pause till 2022. And that's where sort of the inflation analysts are coming in. They're not perceiving inflation in the short term, but they see this turning into inflation in early 2021, the first half of 2021. This monetary stimulus is going to result in higher inflation as the demand from the economy reopening up reemerges.
So you've had a decrease in demand and you've had a decrease in supply. Factories were closed, oil was being shut in. So kind of both went down to some extent. So you're saying that gold, almost like the stock market, which has been going up a lot in anticipation of growth when in fact the economy itself is weakening, is looking past the COVID situation to a recovery and a vaccine and getting the economy back to normal. That's what you're saying the gold market's telling us right now. Is that right?
Yeah, I mean, I think that's the only thing that makes sense, because if you look at the stock market pre-COVID, if you look at it in February, and you look where the value of the Dow was, I mean, if you just look at it from an index perspective, at that point, I thought the market was a little rich. I think then it was trading at about a 20 multiple. Now, you've got an economy that's about 35% open, and the stock market's trading at a 22 multiple. I mean, it makes no sense. So I think the big money is looking through this and seeing a light at the end of the tunnel. Now, if we get a major second wave, I highly doubt the government will again close the economy. But if we do get another major wave and the schools shut down, then I think the stock market could be in some real trouble.
And would gold go along? Normally, you think of gold as counter-cyclical, and gold goes up, but the stock market goes down, and vice versa. But in this case, they've both been going up. Why is it that they're not their usual counter-cyclical selves?
Because I think what people are doing, they've got interest rates at zero, and they're just looking for any type of yield. And precious metals at a zero interest rate structure is just positive for the metals. And there are big players. Look at Buffett. I mean, he's not buying gold physical. He bought Barrick, but he's buying, albeit a very, very minor portion of his overall portfolio. He is putting money into some hard assets. And he's never done that. If you've ever listened to Buffett over the last 10 years, he has absolutely no use for gold. I mean, absolutely no use. Right. He thinks it's the worst investment that was ever put on an exchange. He now has got I wouldn't say a large position, but he has now got a fairly, in our terms, sizable position in Barrick. And so he is starting, when you see a guy like Buffett starting to diversify away from the banks and into precious metals, he's worried. So I think one of the reasons you're seeing gold up here with the stock market is because there's enough worry out there that people are now creating a more balanced approach to their portfolio and not just chasing stocks. They're putting gold and hard commodities into their portfolio as well to give them a little bit of protection against the equity side of their portfolio, which continues to perform well.
Very good. We're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Peter Hugg. He is the director of Kitco's Precious Metals Division, a real expert on gold and silver and other precious metals. You can find out more about him and his commentary at their website, which is kitco.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Peter Hugg. He's the director of Kitco's Precious Metals Division, a real expert on precious metals of all type. You can find out more about him and his writings at kitco.com. Welcome back to the show, Peter.
Good to be here again.
Mm-hmm. So let's talk about some of the physical ways that people can invest in gold and silver and the pros and cons of each. So let's start with gold. So there are different kinds of coins. There are American Eagles, there are Canadian Maple Leafs, there are South African Krugerrands. Those are all kind of the bullion ones, and then there are numismatic coins as well. What is the advantage of doing one over another if you want to do, let's start with coins.
The advantage, I mean, when you ask the question that way, I usually need to compare it to something, but just there is a fairly sizable portion of the investor population, and this is quite specifically more an American type of phenomenon. You don't have that same type of phenomenon up in Canada, where the investor has a complete distrust of the system. Mm-hmm. You know, whether it be the Federal Reserve or whether it be, the government, or whether it be trusting anyone to hold gold for them, whether it's in the form of an ETF or whether it's in the form of an allocated storage account, or whether it's in the form of a trading account.
They want to have it in their hands.
They want to have it in their hands. They believe that it's essential that they have it in their hands. Now, in that context, the only viable option in the precious metals market is obviously physical precious metals. Now, gold coins tend to be, from a perspective relative to the actual cash market or spot market in gold, the most expensive way to hold physical metals. To give you an example, on the Gold Eagle and Gold Buffalo, the U.S. Mint is still the only mint in the world that creates allocations of these two products and prices the allocation of these two products as a percentage. So the acquisition cost for Gold Eagles, Gold Buffaloes for distributors that have direct access to the U.S. Mint is just a little north of 3%.
You're paying 3% over the spot price of gold at any particular time for those.
Yeah,
stores.
That's not the investor. That's the dealer.
That's the wholesale cost.
Yeah, that's the wholesaler. So he's in there at, let's say, just for round numbers, let's put gold at $2,000.
Yeah.
So his acquisition cost is $60 plus shipping, because these coins are usually local San Francisco. So now he's got to get them back to New York or wherever his fulfillment.
And then what is the retail markup on top of that?
Well, then that wholesale dealer generally doesn't sell retail. He sells to other dealers. So he'll mark it up probably 1%. So that's another $20. So now you're at $80. And now the retail dealer, he's got cash flow considerations. He's got insurance. He's got, an overhead especially if he's running a brick and mortar business like coin dealers.
Yeah.
So he's going to add at least another point or two. So now you're in the neighborhood of $100, $120 premium for a 1 ounce gold bar over the market.
Yeah.
Now, whereas if you get bars, 1 ounce gold bars, out of the RCM, there are some other refiners that make 1 ounce gold bars, like Asahi makes 1 ounce gold bars. You can usually get them from a retail perspective at somewhere around $40 over gold. Total premium, all in.
What would be the minimum size of a gold bar?
Well, you can get gold bars. You can also get gold coins as small as 1/20th of an ounce. And you can get gold bars as small as 5 grams, which is about 1/6 of an ounce. But again, all of that stuff right now is not being manufactured. Both the U.S. Mint and the Canadian Mint are totally backlogged in their production of coins and bars. So there is no mint that I'm aware of, sovereign mint. There may be some private mints out there, but there's no sovereign mint that is currently making fractional size coins and or small fractional bars.
So does that mean there's a premium to what's already out there? Because of
if you can find them, basically dealers, what they do is they'll make a bid for product, and there are clients obviously that are holding fractional coins and or smaller bars under 1 ounce increments. And if they're looking to raise cash, they sell them to dealers. As soon as the dealer gets them, obviously they verify them to make sure they're good. Once it's verified, they go up on the site, and there's a lot of people out there looking for small fractional coins. Because again, at $2,000 an ounce, 1 ounce of gold is $2,000. It's not inexpensive from the perspective of laying out cash.
And how about going through Kitco? If people want to buy gold online, what are the advantages of going through Kitco to buy either coins or bars of either 1 ounce or smaller denominations?
I'm not going to say there's an advantage. I mean, what you want to do is you want to go to a dealer that you trust. You want to have a confidence level in the dealer that you buy from, that the product you are buying is authentic. Because there has been in recent history over the last 3 or 4 years, there have been bars in the market that are, use the obvious word, that are not authentic, that are fake. Yeah. Mm-hmm. So you want to go to, so Kitco offers basically 2 types of products, but again, it's we're not. we're not unique in this. There are other dealers that do the same. They offer what's called our product. Everybody has a different moniker on this product. Our product is called Mint First. So if you're looking for a product that has never been circulated, that is coming directly from the Royal Canadian Mint or the U.S. Mint, it's never been in somebody else's hands, we offer that product. For people that have confidence in Kitco, that when other product comes into us, that we do the verification test and we are absolutely 100% sure that the product is good. That is called secondary market product. That product tends to go at a slightly lower premium than Mint First.
Okay. And now you say
you've got to trust your dealer.
There's a new way to do this, which is what you call digital gold, which is called vault chain. Explain how that works. That way you're not holding physical coins in your hand.
No, our product is called, our product is called Vault Chain. There are other dealers that offer this product, again, under their own marketing label. And what the product is, it's a digital platform where clients on a 24/7 basis can buy and or sell gold or silver as little as a tenth of an ounce, like in small fractions. You don't need to buy a lot. And the Royal Canadian Mint is the custodian of the gold and silver, backing this digital platform.
And at any time, according to spot price, it trades
roughly, again, depending on the quantity. It's usually, our product is priced in tiers. So depending, the more you buy, the closer to spot you get. But the average premium on gold is about 1%. The average premium on silver is about just under 2%. But when you compare that to the basis of coin premiums, which are north of 10% on silver, and in the neighborhood of 5 to 6% on gold coins on a retail basis, it gives you the ability of buying gold and or silver very much like an ETF, no storage costs, at very, very favorable spreads. If you're looking just to enter the market, if you then in the future want to take that position and convert it into physical, when the premiums are a bit more, how can I say, normalized, then you can then convert that blockchain precious metals position into physical, and then you would pay that premium at that time for the bars or coins. Now, maybe the premium on Eagles by then is not at 120, it's at 50 or 60.
So that's something you could do through Kitco. If you bought some gold through the vault chain and you said you want to own some physical gold to hold on to, through Kitco you can convert it into and have them send you coins or bars.
Yeah, this is physical gold you're buying on blockchain. The custodian is the Royal Canadian Mint, but it is how can I describe this? It's bulk physical. So the RCM guarantees, and it's a sovereign mint. It's controlled by the Canadian government. Again, Some people don't like that because they don't want anything to do with the government. But if you get over those types of issues in your mind, so if there's 2 million ounces sitting on the blockchain technology of silver, the Royal Canadian Mint stands behind 2 million ounces of silver. Now, if you want a specific product, let's say you want silver maple leaves, then in this current market, you may need to wait a little bit because it's a matter of the mint producing the product for the demand. But if you wanted 1,000-ounce silver bars or larger bars in gold against your position, again, if you had that type of position, the turnaround time for physical is usually within 7 business days.
Yeah. And do you also offer platinum and palladium?
Not on Vault Chain, but we do offer platinum and palladium both in the physical context. And we also have metals accounts at Kitco for gold, silver, platinum, and palladium. The metals are off balance sheet with Kitco, so if something happened to us financially, you would not be a creditor, but you would still have to have trust in the Kitco brand. But again, those metals you would have access to them 24/7. And I find that a lot of people I wouldn't say a lot of people. But, in the old days when I used to trade by, at 4:30 on a Friday afternoon, the market was it. That was it, closed, end of story. And you had to wait until 8:30, the next morning for New York to open, unless a dealer was prepared to give you London quotes while London was open on, early Monday morning. Now the market is 24/7 in the context of access to your metals. So we find that people that have bought that want to transact in blockchain and or in our Kitco Metals accounts, they like the fact that on a Sunday night before the market opens, they can buy or they can sell gold, silver, platinum, or palladium. And that sometimes can be a real advantage. I mean, especially if there's an event that happens over the weekend, you might want to be positioned for the opening Sunday night. And I'm not sure how many dealers offer that service, but we've been offering that service for the better part of 10 years now.
Great. Very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Peter Hugg. He's the director of Kitco's Precious Metals Division. You can see he's a real expert on all kinds of precious metals. You can follow him and his firm at kitco.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour, Peter Hugg, is director of Kitco's Precious Metal Division. You can find out more about what they offer at kitco.com. Welcome back to the show, Peter.
Good to be here again.
Mm-hmm. We've talked about gold and silver. Let's talk a little bit about platinum, which has a precious metals, but it also is used in catalytic converters. What has been the supply, demand, and the price action for platinum, and what do you expect there?
Well, platinum sort of became the dog of the PGM group about a year and a half ago when the Volkswagen debacle happened with their emissions scandal. And, people are moving away from gas engines. And platinum was the most prominent metal in a gasoline engine as opposed to palladium and rhodium. And so the advent of cleaner air has created a situation where the demand for platinum in the catalytic converter industry is gone down probably about 80%.
Wow.
So, and, historically, ever since I've been in this business, there might have been one or two periods in the 40-odd years I've been in this business, 45 years actually, that platinum traded at a discount to gold. Almost always platinum traded at a premium to gold. And because of that change in the demand cycle in the automotive industry, palladium was now looking to be used instead of platinum. When that announcement came out about 2 years ago, a year and a half, 2 years ago, I'm not quite sure on the timing here, palladium was trading at about $700 an ounce and platinum was at $900 an ounce. And once that announcement came out, it just took a while for people to retool, but palladium's never looked back. Prior to COVID,
you would not invest in platinum right now because you don't think it has...
I like platinum, but I like platinum because I'm still bullish gold. I don't think anything has changed. I don't think Trump's announcement on Saturday that they're going to use plasma and that's going to be the cure-all for COVID. And I think that's had an impact on everything. The metals and the equity markets are all, a little bit, wow, this is great. But platinum, I think, because I'm still bullish the overall metals complex, only because I do believe that we're not out of the woods yet. And there is going to be more stimulus, either from the Fed or from the government, which is going to be conducive for a higher gold price. I think gold will take 2,000 out again, and the next time it runs, it will take the high out. In that context, I think platinum goes along for the ride. But the extent of the ride, I think, is somewhat limited. At 920, I don't have a problem being long platinum. I'm looking at a target, if gold gets back to 2,100, of maybe 1,300 on platinum. So in percentage terms, it's still a good return. But I don't see platinum ever being at a premium to gold. Again, the Russians and the South Africans control about 70% of the global platinum production. I mean, if for some reason they just stopped producing platinum and the economy was still somewhat vibrant, the Chinese still prefer platinum over gold for their jewelry. There would still be demand, and if the supply cut off to completely nothing, yes, then I think platinum could certainly surge. But I see platinum as the weak sister here and sort of trading in sympathy with the gold market. And if gold continues higher, platinum will benefit. But if gold tanks, I think platinum could see $800, $750 again.
And palladium is used in electric cars. Is that why it's more in demand now?
It is, but it's a cleaner metal to work with for the gasoline cars that are being made, and so the automotive companies switched over and started using more palladium in the catalytic converters because palladium was cheaper, and now they've got their lines set up for palladium, and palladium is a much more difficult metal to mine, and the supply demand in palladium prior to COVID was they were projecting in 2020 and 2021 a pretty significant deficit in palladium supplies relative demand. Now it's somewhat mitigated because obviously for 4 months now the car industry was shut down. It's now just starting to come back a bit more aggressively in China, but it is starting to come back in Europe. So palladium dropped from 2,800 down to almost 1,500 just as COVID started, and it's been working its way back up, and now we're around the 2,200 mark.
So it's like a recovery metal as well. It's an industrial use. Palladium is not used for jewelry for the most part.
Correct.
Yep.
Palladium is almost exclusively used industrially.
So would you, are there palladium coins, or do you play that through palladium miners? How do you play palladium if you want to?
Again, it depends where you're located. In Canada, physical palladium is taxable, even though the Canadian Mint makes a palladium maple leaf. I could never quite figure out the logic of that. But so in Canada, you can buy palladium in physical 1 ounce bars. You might be able to find 10-ounce palladium bars. There are 1 ounce palladium maple leafs. There are 1 ounce palladium eagles, but the U.S. Mint has only made one lot of U.S. palladium eagles. I think it was about 3-4 years ago. So you can get palladium in physical. In the U.S., it's not taxable. In Canada, it is. You can also trade palladium in metals accounts, and you can also trade palladium in the futures markets if you wanted to. The contract is 100 ounces of palladium.
Okay, so we've talked about physical gold, physical silver, platinum, and palladium. Another way to play this is exchange-traded funds, like a GLD for gold, SLV for silver. Is there an advantage in doing that, which is another way to get at physical gold and silver without holding it yourself, compared to actually holding physical gold and silver coins or bars?
Again, it comes down, Jordan, it comes down to the psychology of the investor. There are, and I don't want to belittle this group. They're a pretty significant buying group in the U.S. That, again, do not trust the system, and they are absolutely convinced that there is no precious metals backing up the ETFs. Even though the Securities Commission says there's an audit and blah, 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 they just don't believe it. So if you have trust, or let me rephrase that, comfort in the system, an ETF is a relatively inexpensive way to play the metals markets because you're basically buying in or around spot. The markups are extremely small. You do have a fee every year, but again, the fee is relatively incidental. It's about 0.25% on the fund. So it really comes down to do you trust that the ETFs have the metals to back it up? Now, the downside with an ETF or with a futures market, if you get extreme volatility, you may not get what I would call a liquid market on your exit.
There'd be big gaps in the pricing.
There could be big gap, but I mean, that's what happened when gold was up. And again, I don't have the exact date, but I'm just going to roughly say 2.5 weeks ago, when it hit 2,200 in overnight trading, and the next day it collapsed to $178 during New York hours. I mean, next to the 1980 sort of collapse, I can't remember another time gold sort of dropped almost $200 during a New York trading session. In that day, trying to get out of an ETF and trying to find a bid was extremely difficult. So you might have seen a bid at, I'm just going to throw a number out there, at $80. Then you go in and you try to execute at 80, and the next thing you know, the bid's 65. So it's that type of.
For a long-term holder who's not doing day trading, it is an efficient way to play gold and silver, you're saying?
Again, if you trust the system and knowing in advance that it's going to cost you about a quarter point of NAV of value relative to the fund every year in administrative costs.
So you are a precious metals expert. Do you trust the system? Do you think there really is gold and silver behind SLV and GLD?
Well, I consider if I buy an ETF, again, No, I don't know. I have been told and I have been assured by both brokers and everything that I've read that any of my brokerage accounts are insured by the securities and by the government and the CFTC for X number of dollars. It's sort of the same guarantee that my bank tells me that up to $250,000 per account.
But that's for your account. That's a different kind of insurance. I'm saying, do you think there actually is the gold and silver in the vaults backing those ETFs that they say there is?
They're either in the vaults or I think they're backed by warrants on the COMEX. But warrants on the COMEX to me are physical product that is sitting in a COMEX warehouse. I do believe that they are backed, yes.
Okay, I would take that as a yes. Okay.
Yeah. But that's me, and I tell you, if I wrote that on Kitco.com, I would probably get 500 comments on my post, and 499 of them would think that I was part of the manipulation.
I see. You're part of the conspiracy, huh?
Yes. Yeah. So again, that's just my personal feeling, and I know there's going to be a ton of people listening to this that absolutely don't agree with me and think I'm part of the problem, but that's just my opinion. So,
are there ETFs for platinum and palladium as well? Is there another way to play platinum and palladium?
I don't think there are for palladium. To be honest with you, on platinum, I'm going to say no, but there might be a small ETF out there. There might be a hybrid something out there that trades in platinum. Again, with the platinum, it becomes more problematic on the physical side. You'd have to do 50-ounce platinum plate. Whereas in the gold ETFs and in the silver ETFs, you can do 400-ounce gold bars, which basically trade at spot, and so do 1,000-ounce silver bars. Platinum, you'd have to get it up to 50-ounce plate. There's only 2 refineries I know in the U.S. that make 50-ounce plate. Anything below that, now you've got premium considerations, which would make an ETF non-functional.
Yeah. So basically, it's not the way to play platinum then.
No, I wouldn't play it that way.
Very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show, and my guest this hour is Peter Hugg. He is the director of Kitco's Precious Metal Division. You can follow his writings and everything that Kitco offers at his website, kitco.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Peter Hugg. He is director of Kitco's Precious Metals Division, an expert on all kinds of precious metals. You can find out more at his website, kitco.com. Welcome back to the show, Peter.
Hey, Jordan.
So we've talked about physical gold metals, gold, silver, platinum, and palladium, the exchange-traded funds. Now, there's another major way to play them, which is the gold mining shares. Now, you have a particular group that you like to play gold mining shares. What group is that, and why is that advantageous over buying direct gold mining shares?
Again, I've sort of had the privilege, or maybe the horror of having been in the mining share market since the 70s, and back in the day, in sort of the late 70s and in the 80s, it was the Wild West, especially with the Vancouver Exchange, and the pump and dump dealers were out there, and everything was just you really just had to cross your fingers that you weren't going to get massacred in that market. So I've always sort of had a somewhat of a I'll be polite, dislike for the junior miners. I used to go to conventions and I'd see the junior miners out there and they'd say, yeah, we've got this great gold discovery. And I says, okay, where is it? Well, we're right next to, pick a name, Barrick, Newmont, a big producer. Okay, so you're right across the fence from them. Yeah. So obviously our gold is going to be the same grade as their gold. And I said, okay. So have you started production? Oh, no. We just know it's there. So now we're going to have to raise money and then we have to drill. And, they were always 3 to 5 years out and they always came back to the well looking for more money, and their CEOs were all getting paid $500,000 a year while the gold was still in the ground. So I got a little jaundiced on the junior miners, and I used to say, if you bought 10 of them, just assume 10 will go bust, and on the 10th you might get a home run. So I like my odds better at a casino. Now there are juniors out there that have good management, but you really need to know what you're doing, or you just buy a basket of them, and one or two of them, yeah, you're going to hit a home run. You're going to get a double, triple, 400%. But it's a very difficult market to play.
So would you play that through the ETF, the GDXJ, for example?
You can do that as well. Again, it gives you a broader range of the group, so you're not putting all of your eggs in one basket. But again, I would prefer, you're not going to get the same bang for your buck. You're not going to necessarily get the home runs. But if you're going to play in the mining sector, I'm much more comfortable playing a more senior / major that has proven production, that has proven cash flow, ideally has a dividend, and treat it more as a sort of normal stock in a cyclical pattern where that group of stocks is moving higher, as we are in now. Same as when interest rates start going, if they're higher and they start moving lower on an equity perspective, if you wanted a position, you would want to consider utilities because you're going to still keep a higher yield and lower interest rates, and that sector will outperform for a time being. So that's the way I would look at gold equity.
What would be, say, your top 2 majors that you would like?
Well, if it's just a major producer, I would be looking at either Barrick and or Newmont. And there's a third group that I like, and those are the streamers. And I like Franco-Nevada, Pierre Lassonde. I know him all the way back to 1979. I think he is the best, bar none, person in the gold.
Why don't you explain how a streaming stock, it's also called a royalty stock. Explain how that works.
They basically lend money and they get a piece of all the action of all the production that comes in. So they don't have any production costs or anything else. They get a little piece off the top of all of the production of anybody that they've got a royalty agreement with. So their overheads are extremely low, and any kind of value move up in the precious metals market, their dollar capitalization on that move is almost 1 for 1. It's immediate because it's not like they've got to dig deeper to get the gold out at a more expensive level, even though they can make a profit. They're just getting their ounces of gold and silver on a royalty basis, and they're just selling them into the market. And as the market rises, all of their royalty values go higher. So if you just look
funding, when companies need funding to do the mining, they're providing the funding in return for a stream of the royalties. Is that basically how it works?
Correct. Yep. And Pierre Lassonde is probably the smartest guy I've ever met in the industry. So if you look at Franco-Nevada or Franco-Nevada Gold, or if you look at Wheaton, and just look at the price performance of those 2 stocks relative anything other than maybe you hit a home run in a junior, you'll see that that price performance is very consistent with an overlay of where the metals markets are moving. you're not going to see silver go from $15 to $25 and see Wheaton drop.
Yeah. What are the symbols for Wheaton and Franco-Nevada?
Off the top of my head, I don't have them. I just don't have them in front of me.
I think Wheaton is now actually called Wheaton Precious Metals. It used to be called Wheaton Silver, but I think
That's correct. It's Wheaton Precious Metals, yeah.
Are there any other streamers in addition to Franco-Nevada and Wheaton that you like?
Those are the two I like. I mean, I don't really spend a lot of time and I don't dabble either on my personal account, and we certainly can't do it for our clients because we're not a registered broker in the equity space, in the mining space.
Yeah.
But if I have clients that ask me that question, I give them my opinion as to if you are getting into that area, you'd want to consider, and again, whether it's Barrick, and it turns out that, what's his name? Oh God, his name just slipped my mind. The billionaire, the guy that just got into Barrick.
Warren Buffett.
Warren Buffett. So Warren Buffett seems to agree with me. He likes Barrick. I've liked Barrick for the last 3 years. And Franco-Nevada and Wheaton, I've been a proponent of both those companies from the quality of their management. Now, there are times, if I was a trader, I'd be selling Franco-Nevada or Wheaton if I think there's a correction in the market coming, because they tend to mirror the market very closely. But if I'm bullish and I want to be in a stock as opposed to being in the physical market, those are two that would be very high on my list.
Yeah. Just to take, before we close, kind of taking a look at the big picture again, what could go wrong with this current bullish scenario we've got? Basically, you're saying the Fed and the central banks are pouring out money for a long time. So basically nothing could go wrong with gold and silver. But we were in a bear market for a long time, from 2011 until the last year or so. What could go wrong with this whole scenario?
Well, you've got to take it in the context. So when you look at 2008 to 2011, when gold hit the 1924, 25 top, in around there, within a couple of dollars of that number, the Fed was full pedal to the metal with an easy monetary policy because of the financial issues that occurred or started to occur in 2007.
Yeah.
In 2011, the Fed gave notice, and they said, okay, the easing cycle is now stopping. We are going to start to tighten the system. And as soon as they said that, the dollar started to rise. And, we had a fairly good appreciation of the U.S. dollar from about 2011 till 2019. And in a rising interest rate environment, the interest rates didn't go crazy, but the 10-year got north of 3.7, and in that environment, the metals were not attractive. The equity market was rallying. There was no real fear in the market, and the precious metals basically took it on the chin. And in 2019, late 2019, it became apparent that the markets were holding up well in an environment where the equity market was doing well, and the Fed was actually not talking about lowering interest rates. So in that context, that was the first bullish sign when the metals were not dropping in 2019, with a very strong equity market and the Fed not indicating any type of easing coming anytime soon. In fact, the Fed was talking about raising rates, and the metals did not go down. The gold market did not collapse. And that was the first sign that something was coming.
So you're saying the next thing, we have about 2 minutes to go, is if the Fed started saying they're going to stop easing or even tightening, that would be bearish for the precious metals. Is that what you're saying?
Yeah, but I think that's at least a year and a half away. I think this cycle has got a lot of legs ahead of it. Now, what could happen? A complete collapse in the equity market if the economy reshuts down and we go into, whether you want to use the D word, depression, and everything basically just sort of implodes. In that context, I think the metals are going to get hurt as well. I don't see them running up in that type of economic environment, because cash then will be absolutely king.
Mm-hmm. It's interesting because you normally think of gold as a place out of fear, and if the economy is collapsing, we're going into depression, that's the ultimate things that people fear about. But you're saying that a major deflationary event like that would not be good for gold and silver.
No, I think cash would be. I mean, people are going to be struggling to pay their bill, their rents, and everything else. They're going to need cash. A 1 ounce gold bar is not going to do them much good.
Very good. Well, thanks so much. My guest this hour has been Peter Hugg. He's the director of Kitco's Precious Metals Division. You can find out more about his writings and what Kitco offers at his website, kitco.com. Thanks so much. We've learned an awful lot about precious metals, Peter. Thank you.
It's my pleasure, Jordan.
Thanks again. We'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.